Hello everyone, this is Fuad Guda. I will be assisting you to understand more about accounting and how accounting is really made easy. So, let's start. This is lecture 1 about the foundations, and we will continue discussing the foundations in the next few lectures. Okay, so let's start globally. Why are we doing this? So I'm doing this for the sake of all students, to help them more to understand about accounting and how accounting is a very easy subject, and it brings you lots and lots of money and knowledge. Okay, so let's start up. Accounting made easy, lecture 1, the foundations. What's accounting main target? So we are here actually speaking about why this subject is existing in the first place. So why it exists. So if we right now we are having a company, imagine that you are the owner of any firm or company, and you need to know, did you just make profit or a loss? You are gaining money, you're losing money. What's you what's your firm position right now in the industry? How would you know that? How would you know that? We are getting to know this info through the science of accounting. So mainly accountants exist for preparing and communicating the financial statements. These type of statements, which provide the owner and the intended management the needed information about the company, whether they are gaining money, losing money, do they have a liquidation, or all of their assets are in a sold state. So they have like the whole idea about the firm through financial statements. There are lots of types of financial statements, and we are going to explore each in the next lectures. So, for point 2, financial statements, we should ask about when are we doing financial statements. So, let's ask about the time. So, there's two types. The official financial statements, that's for the government and that's for the taxes. We issue it annually. And by saying annually, we have a term in accounting which is a fiscal year. What's a fiscal year? That's a 12 month of period. According to the calendar year, which means if I start on day 1st of January at 2020, so 31 of December 2020, that means like we have a fiscal year. It's 12 months from the start of the year and end of the year. Okay, so just 12 months from the start date, that's called a fiscal year. Okay, let's move. Financial statements are prepared monthly, quarterly, semi-annually, which means each 6 months, for internal managers and management purposes. So here is the key. If you are a manager in accounting or in a business sector, so how would you know if your company is making money or not? So if we didn't prepare it like quarterly or monthly, how would we measure? So it's for internal managers to take appropriate decisions. But for the government, it's annually. For the taxes, it's annually. Alright. And for better communicating to the owner, so if we prepared it monthly or quarterly, we would tell the owner that your company is at this exact position. Understanding the accounting equation. Okay, let's have like a story to understand the equation and how this equation real or not. Okay, so let's imagine that you have a friend called Jack. So we have Jack here, imagine with me, and he's telling me, "Hey Fuad, how are you doing?" "Hey Jack, how's everything going with you so far?" "Oh, it's good." "Alright Jack, what do you want?" "Hey Fuad, I would like to open a business. I would like to ask you about it." "Oh, really? That's pretty good. Damn, man, you're getting a new business." "Oh, yeah." "Okay, what do you want, Jack? How can I help you?" So Jack tells me about that. "Hey, Fuad, I have $100,000. I said, "Alright, what will you do with them?" He said, "I want to open up a business that's for delivering stuff." I told him, "Okay." So Jack needs a car to deliver those stuff. Okay, so he went to the dealership and asked them about the car's price right now. So as I said, let's make it like a Jack have an 80. Yeah, let's make it like an 80. Okay, let's say that Jack has 80,000 pounds right now. Let's write it in order to simplify it. So yeah, 80,000 pounds. So he goes to the dealership, and the dealership told him that the minimum car is for $90,000. Alright, and Jack has only $80,000 or pounds, whatever the currency is. Alright, Jack has 80,000 pounds. So I told him, "Alright, that's a big problem you have to face. How about taking Jack, you need to take a loan from the bank, because you know that if you really took the $10,000, you will only have a $90,000, and the business is not all about the car, man. You know, you will have to pay salaries, you will have to pay the rent, you will have to have money in order for anything happens. You have money to pay for the utilities and for the ongoing process." So Jack is convinced by my idea, and he goes to the bank. And when he goes to the bank, he took $20,000. They only approved him at $20,000 for the sake of simplicity. Okay. So now Jack took the $20,000. He bought the car for $90,000, and he got a safe. I told him you have to get a safe inside the firm, and you will add or put inside this safe that the other $10,000, for the sake of anything happens, you need a liquidation, you will have the money. This money, the £10,000 or $10,000, you will pay it you will pay from them. You rent, you will pay salaries, utilities, etc. Okay? So now let's dig inside more. We have a resources and we have a sources. What are the sources of Jack? The source of Jack, the $80,000 that he was having in the first place. Beside that, the £20,000 provided by the bank. So these are the sources of the whole organization he's gonna do, all for his current business. Okay, we call these sources equities. Source equities is a term used in accounting. Okay, what are the resources that he already bought with this money? What are the resources needed or exist right now in the new company? The car, which is for $90,000, and the other cash that exists in the safe. So when we calculate both of these, we'll find that they're equal and they are both a $100,000. So we came out by equation to simplify this story. I hope this story will make it easy. It's called a basic accounting equation. What's this equation about? It's about assets equal liabilities plus owner's equity. What is assets? Assets are the resources. Alright? So this is the assets. Assets is for $100,000. Equal, which is equal. Liabilities. What's the liabilities? It's like the 20,000 loan. You took a loan, so you have a liability to pay that loan. Okay, so any loans will be considered as a liability to you. You have to pay it later. So this is called the liability. So $100,000 equal $20,000 plus owner's equity. Let's remember his capital. He was having in $80,000 to start his own business in the first place, at the beginning of the story. So that's $80,000 plus $20,000 will equal to $100,000. So assets equal liabilities plus owner's equity. We call it basic accounting equation. Alright? This equation will continue with us. Okay. Let's dig more and see that example. We provided service to our customers. Let's say that this is a company. Okay, that's my friend's company, Jack Company. Okay. Jack Company provided services to our customers valued $65,000 collected in cash. Okay. We spent $15,000 to run our operation and paid all in cash. Okay. Let's see. We have financial statements to help us understand more whether we have made net income or net loss. What's our capital right now? So we have questions to ask and financial statements to answer. So the first question, and we will arrange it. Okay, we will arrange this. The first question we have is, did we made a profit or did we made a loss? So this is the first question we will have to answer, and we answer this question by a financial statement called income statement. So this is the first statement that we are going to do. Okay, how to write the financial statement? First of all, you write the date like this, December 31, 2021. Okay. Second, you will type the company name. Let's imagine that this company name is Foster. So in the next line you write the company name. In the third line you will write what's this statement that you are doing. It's called an income statement. So we are preparing an income statement right now, and this you won't need to write it. I just wrote it to understand more about the income statement. Alright, so for the year ended on 12/31/2021. Why did I wrote for the year ended on? Why did I do this? Okay, let's make a bold. Yeah, because simply we need to know for the whole year what's our results. So according to all the transactions happened from the 1st of January 2021 to the last day in 2021, what have we done? Have we made a profit or a loss? So for the year ended on, okay, if I removed for the year ended on and just typed on 12/31/2021, that means in this exact day did I made a profit or loss. So let's start how to write it. We will have like a table. Okay, the table is consisting on my left hand we will write the items, and on my right hand we will write the numbers. So let's read again. Jack Company provides services to our customers valued 65,000 collected in cash. Alright, and we spent 15,000 to run our operation and paid them all in cash. Alright, so we did services for 65,000. This called a revenue. So we earned a revenue. We write revenue for $65,000, and we had to pay $15,000 expenses to run the operations. Okay, so we write minus expenses, and in the accounting we don't write minus 15,000. No, we just put it inside brackets, and this called this inform us as accountants that this is in minus. Okay, so this is a minus form in accounting language. So revenue minus expenses, $65,000 minus $15,000. Okay, it will be $50,000. Is it in positive or in negative? Oh, it's in positive. That means we did a profit. Profit is a net income. Is another term for net income. So profit. Alright. So this is the first equation. It's called income statement equation, to ask yourself about this question, whether I am winning or losing. Am I making money or losing money? That's the first question you have to consider as an owner or as an accountant. Okay, so congratulations, you are making money. You made this year $50,000. Okay, second question to ask. Okay, how's my capital? Is it growing or not? So let's ask about the second statement, which is OE statement, owner's equity statement. My capital, is it growing or is it declining? What's happening? It's called an OE statement, owner's equity statement. It aims to show the change in the owner's wealth during this period. Am I getting rich? Am I getting poor? What's going on with my or equity at faster company or first. Let's make it like fast. Okay, let's say faster is a good. Yeah, let's change the name. Okay. At faster company, Mustafa began the business with capital 80,000 Egyptian pound. Okay, so we have two capitals. The starting capital, what was Jack or Jack? What was Jack? It was Mustafa. What's Jack capital when he came to me asking for an advice? It was only the $80,000 that he had, right? So that's called a beginning capital. We are moving and proceeding to see if that specific capital increased or decreased. So we call it a capital beginning. We have a capital beginning, which was the $80,000, okay, cash, plus whether he lost or made a profit, which is we will need it from the previous statement, the net income, which is profit one. So we will add this number, net income profit, or net loss, whatever the result is, and we will add it plus net income. So here it's 50,000. We will add the 50,000. So capital ending is $130,000. So imagine it, okay, and make it like story in your mind. We had an 80,000 cash, okay, and we did revenue, we paid expenses, we had a profit of $50,000. We will add this profit to the previous capital, which is a capital beginning, and we end up by having the capital ending, which is $130,000. We won, we made a profit, our equity our equity is now increased. That's it. It's simple, very very simple statement. Okay, so this is the second statement. We can write here to simplify things on you. First question: am I making money or not? That's the first question to ask, and to answer you will need to do the income statement. The second question to ask: how is my capital growing? Alright, that's a very good question actually. Third statement is called the balance sheet. We deal in the balance sheet by the simple accounting equation, which is assets equal liabilities plus owner's equity. And I had really a good question to ask right now. Why we said assets equal liabilities plus owner's equity, and why not owner's equity plus liabilities? That's a really good question, because when you have like as stakeholders, you have like a big firm, and you are not the only owner, and you have stocks in the market and lots of liabilities. And let's consider in the worst case scenario that you need to liquidate all of these assets and pay the stakeholders their part, and the other owners their money or the liabilities. Okay, what will you do? Would you take your own money first or pay the liabilities first? In terms of accounting, we care about the other owners or the other stakeholders more than us. So we need to pay them first. We pay the liabilities first, and then we check our owner's equity. That's for transparency in accounting, and that's for trust in accounting. Okay, that's values. So for foster company, that's called the balance sheet. The balance sheet is made on a specific day. Okay, it's not over the whole year. Okay, so it aims to measure the ability to stay in the market for the long run. Am I able to stay in that market, or should I liquidate and go to other business? On 31/12/2021, we have like, sorry for the noise. Okay, we can try it for the year ended one. So assets like cash, yeah, let's make it like simple story again. Assets equal liabilities plus owner's equity. Okay, so what assets did we have? Okay, we had cash 10,000 and we had a call 90,000. Let's proceed to the story. Let's check for the cash. Okay, we had like a 10 from the beginning of the story. We had like a 10,000 pounds in the safe, right? This is the first cash we had. Then, continuing the story, we took 65,000 pounds, dollars, okay, whatever, 65,000 generalized, and then we spent 15,000. Those all in cash, so we have to put all the cash items inside the balance sheet. So let's calculate it. Cash 10,000 plus 65,000, that's 75,000, minus 15,000, which will end up to 60,000. So cash equals to 60,000. The COGS equal to 90,000. That's our assets. So total, we got it like cash, COGS, total assets. What's our total assets right now? It's 150,000. So assets equal liabilities. Let's look at the liabilities. We took from the bank 20,000 pounds. So liabilities for 20,000. That's the bank loan, right? That's a bank loan. Owner's equity, we had an 80,000, right? Oh, let's proceed the story. Let's check our new owner's equity. We had an 80,000 as a beginner at the beginning, capital beginning, and we added the net income, so we have a capital ending. What was it? 130. So our new capital is no longer the 80,000. It's 130,000. So we will have to proceed from this point. So owner's equity, capital ending 130,000. Let's calculate them. We will find that assets 150,000 equal liabilities plus owner's equity 150,000. So we have, yeah, so that's the third statement that we provide. It's called the balance sheet, or has another name, the position of the company. Alright, we have something called related disclosure. What's a related disclosure? So for example, if this car that I bought for 90,000 pounds for any crisis, okay, for anything happened, literally it's now for just a 10,000 pounds. So I will write COGS 1, I will write a small one, okay, beside it. That should be a small one, okay, and here I will write notes 1, and I will do like this. Related disclosure means notes provided, okay, so I will write 1, sorry. The current value of the car dropped by 80,000 to value currently only 10,000. And I can write the date on, for example, 31/12/2021. That's called a related disclosure. So I can write cars and give it like a number, and there under the financial statement he can read about the notes to get to know more about what's the economical events occurring and how this affects his business. Alright? That's called a related disclosure. The cash flow statement. The cash flow statements provides us with the general idea about, do I have enough liquidation if I need it, if my partner wants his money right now. He no longer wants to be my partner. He just wants to take his part and his profit, and he will no longer invest with me. Can I pay him? Or all my assets are in a form of like a solid, like cars, mobile phones, furniture, or is it cash? That's the cash flow statement. That's mainly for this. It aims to explain the reasons for the change in cash balance, what happened to change that cash balance. And it aims to measure the ability to pay liabilities in the short run, as I said. That's a liability. Your partner need to get out of this business and he wants his money. So a liability that you need to pay him his money. We have a summary here. It's really an easy one. Look, we have a 5. Can you see me? We have a 5 items that help us prepare a 5 statements. Alright? So first thing is assets, liabilities, owner equity, revenue, expenses. Okay, so assets, liabilities, owner's equity, revenue, expenses help us to establish 5 statements, which is income statement, owner equity statement, balance sheet, cash flow statement. And related disclosure is not really financial statement, so by using these 5 items on my left will help us prepare the 4 statements on the right. Okay, let's check for each statement equation. For the income statement, it's just for revenue minus expenses. For owner's equity statement, it's just for capital beginning plus the net income or net loss to provide the capital ending. Balance sheet, it's for the basic accounting equation, which is assets equal liabilities plus owner's equity, and the cash flow statement we will discover in the next few lectures. We have some questions here to answer. First off, the basic accounting equation states that assets equal liabilities. Is that right? Okay, let's review. Assets equal liabilities plus owner's equity. Can I see owner's equity? No, so it's wrong. Number 2, net income for the period is determined by subtracting total expenses and drawings from total revenue. Okay, let's check how we can determine is this net income or net loss. Revenue minus expenses. Okay, it's determined by subtracting total expenses and drawings. What's drawings? I just know the expenses. I don't know drawings. So that's wrong. Alright. During the year 2021, her net company earned revenue of $25,000. So that's revenue, had expenses of 15,000. Okay, 25,000 is revenue minus expenses minus 15,000. Net income or loss. Alright, we made an income for 10,000 Egyptian pounds. Second, during the year 2021, Habiba company earned revenues of $15,000, had expenses of 25,000. Oh, right. Net income or loss. So here the expenses is more than the revenue, so we made a loss. How much loss we made? 10,000, and it's in between brackets, which means it's a loss. It's subtracted minus. Okay. I hope you complete the other questions here from 3 to 7. We'll take it as a homework, and kindly let me know your answers in the comments below. Okay, I hope this is a very easy video for the foundations lecture 1. We will continue in the next lectures. Alright, let me know how ready you are now to solve these questions, and let me know your answers in the comments. And sorry for any noise that happened, because I'm living in a cozy place. It's not like it's a noisy cozy place actually. So see you in the next videos.